Hello, everyone, and thanks for joining. Today, we are going to be discussing long term care planning and how planning early can help to improve your long term future security. And for those that don't know me, my name is Luke Yango, and I am a financial planner within Continuum Consulting Group. But before we begin, let me give you an overview for all of those that aren't clients on the line. But first, as always, a quick disclosure from our compliance department. Now, we're a boutique wealth management and financial planning firm here in Irvine, California. However, we do have clients across the entire nation. And what we do with our clients, as I mentioned, many are on the line today, is work with them on their holistic financial planning and investment management needs. We take a comprehensive and we take a holistic approach to planning, which means we work with our clients beyond just their investment portfolio. And our process to planning involves first building out a well designed financial plan, then organizing our clients' investments in direct coordination with that plan, and then ensuring that any outside planning items have been handled. And here's a quick overview of our team. And within the firm, we have 7 financial planners, myself included. We have a retirement plan specialist, an investment specialist, and then 3 administrative assistants. But enough about us, let's get into today's topic. And if you've joined a webinar in the past, you know we focus our educational seminars around the idea of the planning pyramid. And for today's conversation, we are going to be discussing how proper long-term care planning can assist to better improve your retirement planning, your health planning, and of course, risk management. And for today's agenda, we are going to specifically discuss what exactly a long-term care contingency is. Then we'll get into Medicare and Medicaid and discuss their role in long-term care planning. Next, we'll discuss some of the varied options that you have to cover long-term care. And this is not going to be a sales pitch for insurance. Obviously, insurance is one way to provide coverage, but there are other options, and being aware of those options will help you make a educated decision on what is the right course of action for you and your family. And then lastly, we'll discuss some of the next steps involved with starting a long-term care plan. Now, for the clients on the line, this may be a little bit of a review from what we've discussed in our planning meetings. However, it is never a bad idea to get a refresher. So let's start with what exactly long-term care is. And simply put, it is the need for assistance with the activities of daily living, which are being able to eat and feed yourself, to bathe and groom yourself, to dress yourself, to use the restroom without the assistance of others, the ability to transfer yourself, and lastly, the ability to control your bladder and bowel functions. If or when you get to the stage in life where you're unable to perform certain activities of daily living, that is usually when you're in need of long-term care. And additionally, any severe cognitive impairment would be another condition that would potentially create a long-term care contingency, like dementia or Alzheimer's, for example. And the thing about long-term care, which is important to understand, is its job is to help you maintain your independence. It's drastically different than providing you health care. For example, healthcare is going to be covered by medical and health insurance usually. It's the stuff that can get done at your doctor's office or the hospital. And generally, healthcare related costs are designed to get you healthier. Long-term care, on the other hand, is about maintaining your independence, which means helping you cover the costs associated with with the assistance of activities of daily living. And those costs would involve anything associated with special care you may need at some point in your life, for example, needing someone to assist you around the home or needing personalized care in a nursing home or assisted living facility. And generally speaking, you are in need of long-term care when you're unable to perform 2 of the 6 daily activities of living. But the majority of long-term care issues do come near the end of our lives when we're much older. And that is simply because as we age, our bodies tend to deteriorate. And for the majority of seniors, at some point in their lives, they will require some assistance needing these or performing these activities of daily living. However, many people tend to avoid the conversation around long-term care planning because it's something they feel like they just won't have to worry about for a while, or it just won't happen for them. But the fact of the matter is, experiencing a long-term care contingency is actually fairly common, and planning for it early on in your 40s, 50s, 60s, maybe 70s can dramatically help. So I'm going to show you some surprising facts here, and I'm not showing you these to scare you, but just to educate and explain that long-term care is something to think about. And the earlier you begin the conversation, the more time you're going to have to plan. First, if you reach the age of 65, you have over a 50% chance of needing long-term care. And the average stay in a nursing home facility is about 2 to 3 years, with about 15% of patients staying over 5 years. We'll get into the specific costs shortly, but overall, the longer you live, the greater your chance of needing long-term care is. And people are living longer lives, which means that we're probably going to continue to see a rise in long-term care needs for Americans just because life expectancies are going up. Secondly, there are a lot of misconceptions around long-term care. The first, the majority of people believe living a healthy lifestyle reduces their risk for experiencing a long-term care issue, but it actually increases it. And that may seem like a contradiction. However, the healthier you are, the older you'll live on average. And just like I mentioned, the longer you live, the higher the probability of needing supplemental care becomes. And about half of Americans will say that their spouse is their long-term care plan, meaning that their spouse will assist them when they're unable to provide for themselves. However, the majority of people have not had that conversation. And not only that, but if that is truly their plan, then when one spouse passes, the other spouse will be completely out of luck. And those that use their spouses as their long-term care plan tend to have worse care and put an unwarranted and unwanted burden on their loved ones. But overall, long-term care is something many people will need at some point in their lives. This is the whole point of this slide. So let's just get into the type of care available and then a little bit of an overview on the cost. And as you can see, there's a lot of different options for paid care. A lot of times, whichever care is provided depends a lot on your financial, family, and your health status. These options range dramatically in quality, usually dependent on the price that the facility or the organization is charging. And the care provided will also vary dramatically on whichever option you are utilizing. Generally speaking, care that is needed and care that is provided is kind of on a spectrum, with additional care needed as an individual ages. Like I mentioned in the previous slide, the average stay in a nursing home is around 2 to 3 years. However, care generally starts before then. For example, whether you pay someone or a family member assists, people usually receive some sort of care prior to moving to a full-time facility. Whether it's a spouse or a family member, most individuals are receiving aid before they're in a nursing home. Many times it starts out with home health care and potentially an intermediate aid facility like adult daycare, for example. And then as age takes its course, many times people do see themselves in a full-time facility, whether that be nursing home, assisted living home, or residential care facility. I'll tell you a quick story. I saw this happen with my grandma personally. As she aged, she had a great life, but as she aged, my family started to have to help more around the house with her. She eventually moved very close to one of my aunts. My aunt took care of her for a handful of years, and then eventually she went into a nursing home. And it just goes to show that care truly is on a spectrum. And what's important to also understand are that the cost of these facilities are not necessarily the cheapest. And in my state of California, costs are actually fairly consistent with national averages. In California, on average, the price for a nursing home facility is about $135,000. And these types of facilities provide around the clock care and are able to provide a high level of support. The monthly cost for a private bedroom in a residential care facility would be a little less than $6,000 a month. And these facilities do not provide as much care as what a 24-hour nursing home facility would. And often they're good for those that are able to care for themselves, but do need certain assistance for certain things in life. And then if you needed at-home care, you're looking to pay for about $30 an hour for that care. And generally, you pay for either a full day or a half day when you need care. And what goes without saying is that the facilities that offer more in the way of care, luxuries, and even independence typically are going to be a little more expensive. What I'm showing you here are averages. But one thing to note and to keep in mind about developing a long-term care plan is that on average, those that have a plan actually receive better care. And the reason being is that they have the funds to get care early on before their condition may get too extreme. For example, if you had money specifically set aside for long-term care and you started to need care, rather than just having your loved ones care for you or not having any care at all, you start paying for the care and you do so because you planned on it. So while these costs may seem high, developing a plan early on and then setting aside the funds in whichever manner you decide to do so could preserve or could help to preserve your health, your quality of life, and potentially even your wealth. And there is one misconception that is fairly common that we need to address before we get into the specific options for covering care. And that misconception is that Medicare or Medicaid will cover the costs you may experience related to long-term care. So let's first talk about Medicare. Right now, Medicare is not going to cover long-term care because it really wasn't designed with long-term care in mind. Generally, Medicare will cover about 30 days in a skilled nursing facility after a 3-day stay in a hospital. After that, it'll cover about 60% of the cost of a skilled nursing home care for about another 30 days. And then it'll cover an even lower percentage for about 40 days, partially covering 100 days total. After that, Medicare really won't cover anything. The nuance with the short-term coverage, though, is that Medicare, as I mentioned earlier, because it's health insurance, is really only designed to help pay for coverage that gets you better. So if your health has plateaued or you show no signs of improvement, often Medicare will actually stop paying. That's why I mentioned that it's really not designed with long-term care in mind. So generally speaking, don't plan on Medicare for your long-term care. Medicare is health insurance. And with Medicaid, there are certain eligibility requirements that you must meet to qualify to receive benefits related to long-term care. And simply put, you just have to have very, very limited income and resources to receive any aid. And the aid you would receive probably isn't top tier. Essentially, you must deplete almost all of your assets, have close to nothing to qualify, and then receive benefits. And then the care that you are receiving, it may not be up to your standards. Everyone's different though, but you're not going to be staying at some beachfront nursing home with extremely personalized care. You might not even have a room to yourself. So if you have the means to plan for something else, then doing so typically is best. And personally, I would prefer to stay at one of the nicer facilities if I was nearing the end of my life and needed daily assistance. Just because you're older and you're in a long-term care facility doesn't necessarily mean life has to lose value. You can receive the care you need and maintain your standard of living, but then also enjoy your life. My mom, for example, works at a long-term care facility in Cincinnati, and some of the residents have been there for years. And a lot of them are still enjoying their lives. They're just there because they need assistance and they don't want to put that burden on their family. So let's jump right into the options then to cover care. So we just discussed what being covered by the government means, and that really boils down to essentially nearly running out of assets. So the second option would be family coverage, which we touched on briefly earlier. And while there is nothing wrong with considering family, there are 3 very important things to keep in mind. 1, does your family know that they will be responsible for you in the event of a long-term care issue? Second, are they qualified to provide you the care? And third, are you certain that you will be there when the time comes? There are obviously more things to consider when thinking about family to cover your care, but these are a few key issues to think about. For example, I've had this conversation with my family, and while they don't have a concrete plan built yet, they do know that I have told them that I will be there in case of an emergency. Another option is to self-insure and to cover the cost, and there are a few methods to do this. First, you could just wait it out and see if you have a long-term care cost and hope that you have the money available. But the more proactive option would be to specifically set aside money for future care costs. And we'll discuss this in a little bit as we review the next slide, and we'll talk about the benefits and the negatives to the strategy. And then lastly, you could transfer all or part of the risk to an insurance company. The idea behind using insurance to pay for long-term care expenses is really the concept of tax-free leverage. And what I mean by this is when you use a long-term care insurance policy, it's not a dollar for dollar exchange. If that were the case, it would defeat the whole purpose of insurance. Instead, the way long-term care insurance works is for every, let's say, $1 you put into the policy, you might get $5, $6, or $7 of benefit for the future. And you can usually access those dollars tax-free so long as you're utilizing them for future long-term care expenses. That is a very important concept to understand if you utilize insurance for your planning. But there are two models of long-term care insurance, generally speaking, which are traditional insurance and hybrid insurance. And with the hybrid insurance, there are fixed policies and investment-based policies, which we'll get into shortly. And as a quick summary, think of traditional insurance kind of like car insurance. You will always pay for it, either monthly or yearly, and when you need it, you use it. While with hybrid insurance, you generally have a set amount of payments which eventually stop, and from there on, you'll be covered indefinitely. And then there are other features to hybrid policies as well, which we'll get into shortly. But let's first talk about the pros and cons to self-insuring and traditional insurance, because these, in my opinion, are the two most straightforward options. And with self-insurance, the main benefits are that you are going to maintain control of your assets. You're not dealing with an insurance company, which means that you don't have any additional monthly cost or restrictions. But with that does come the risk of depleting your retirement assets for you and your potential spouse if you were to suffer a long-term care issue, or potentially just not having the funds there when needed. And if you specifically set aside funds for long-term care and you invest those funds, you obviously are going to have to worry about the ups and downs of the market. And even aside from those issues, you may have a tax issue when ultimately paying for costs of care, because unlike long-term care insurance, when you pay for coverage out of pocket, you don't get as favorable tax treatment. For example, if you're pulling from an IRA at retirement, which is a retirement account that hasn't been taxed yet, and all of a sudden you need an additional $100,000 a year to cover long-term care expenses, well, that's going to require you to pull well over $100,000 out because you still have to pay for the taxes on it. And depending on your tax bracket, that could be very high. So a $100,000 expense may turn into a portfolio depletion of maybe $130,000. And if you continue to experience long-term care costs, the costs continue to compound on each other. But I do like to say that a lot of people really like this option because they want to control their assets and are willing to take the risk in the future. And also they don't have any additional costs from an insurance company, which many people truly dislike. Now, another straightforward method to insuring is traditional long-term care insurance. And this is really the first generation of long-term care insurance, and it was created, I believe, back in the 1970s. Now, these policies were designed to basically be how car or homeowners insurance works. It is a pay-as-you-go model. As long as you have it in force, you pay. The challenge with traditional long-term care insurance, though, are really three things. First, as I mentioned, it's a lose it or use it type policy. So if you never need benefits, then the issuing company is most likely going to keep your premiums. Secondly, they're generally designed on what's called a lifetime premium payment plan. You're required to pay until you turn it on, meaning you pay until you need long-term care. Third, the premiums are not locked in or guaranteed in most cases, which means that your premiums can actually increase as you get older. Now, these products are not necessarily bad, but there are a fair amount of issues that can come with them that have driven many investors away from utilizing these types of policies. You do know, however, how much benefit you would have with this type of insurance, meaning you know how much would be paid to you to help to cover your care. But the challenge with these policies is often you don't have assurance with how much you're actually going to put into the policy in the long run, how much your premiums are going to be. So that really leads me now to the second method of insurance, which are hybrid-based insurance policies. And these were essentially built off traditional long-term care insurance. And I'll talk about the first method, which is fixed hybrid insurance policies. Now, these were built and designed to address the three main issues we see with traditional long-term care insurance. And at their core, they're actually life insurance policies with what's called a long-term care rider. Now, the first feature to hybrid type policies are that you have access to long-term care benefits if you need them. However, unlike traditional insurance, there's a small life insurance death benefit attached to the policy if you don't use it. So it's paid out tax-free to your beneficiaries if you never use the policy and never pull any money out. So with these policies, it's actually a way to leave a small legacy if you don't need long-term care. Essentially, these policies were designed to get rid of that use it or lose it type of contract because to many investors, it was very unattractive. The second feature is that instead of the policy being designed on a lifetime premium payment plan, it's actually designed in most cases on a set premium plan. In my opinion, this is the most important feature because it's customizable where you can really pay it off after 1 year or spread it out over time. The idea, though, is that you know exactly how many premium payments you have to put into the contract, so it alleviates the risk of living a very long, healthy life, continuing to pay into a traditional long-term care insurance policy, and then never receiving anything from it. Basically, everything is locked in and guaranteed in most cases. Your benefits can't be reduced, you can't get an increase in your premiums, nothing. The only worry is that it's an insurance company, so you want to make sure it's a credible insurance company that has claims paying abilities for years to come. Now, the reason many people like these types of investments, as I mentioned, is that you're going to have some certainty. You're going to know exactly how much you spend and how much your benefits may be. It's very transparent. And as a financial planner, you can build it around your financial plan because of that certainty. And then there is one last feature, which I think is kind of unimportant, but you typically have the ability to take all or part of the money that you've put into the policy out if you decide to cancel the policy. However, if you get a long-term care policy, I don't necessarily know why you'd like to surrender it, but that option is still there in the event that you wanted to get rid of the policy. So that's the fixed hybrid option. I know that was a lot of information, but now we're going to move on to one that's even a little more complex, which is an investment-based hybrid option. And really, it's going to have the exact same features that I just talked about. So you're going to be have some certainty about you're going to have certainty on the amount of dollars that you have to put into the policy. You'll still have a death benefit. You'll still be able to pull your money out if you decide to cancel the policy. And of course, you'll receive long-term care benefits, which will be tax-free. But with this method of insurance, you actually get to pick the underlying investments within the policy, which ultimately play a very large role in determining your future long-term care benefit. For example, with the fixed policy that I just spoke of, you receive growth on a yearly basis of your long-term care benefit by some fixed amount that is predetermined as a part of the policy. And you know what that is ahead of time. So you have an idea of what your benefit would be at age 70 versus age 90. And many people really like that because they have 100% certainty on what their benefit would be at a certain age. But others prefer to take on a little more risk and to invest those funds for more growth. And that's exactly who these types of policies are designed for. Additionally, these types of policies are great for younger investors because it's a way to tuck kind of a small amount of money away on a yearly basis for potentially future care needs, and also to invest it to hopefully allow for more growth of your benefits. For example, let's just say a 40-year-old starts investing into a long-term care policy. They realistically wouldn't use it for maybe 40 to 50 years, so they can probably take on some investment risk, knowing that they'll be better off investing during those years rather than getting just a fixed guaranteed rate of return. And of course, the benefits are tax-free, so it's a good way to plan for future care needs without increasing your future tax burden. And lastly, there is what's called a floor to this policy benefit that increases dependent on your investment performance. So you can be certain that you're protected from a major market downturn as your investments grow over the years and are invested in the policy. So let's review all the specifics now to this to summarize it. And the best way to explain would be through a graph. So let's take a moment to look through this graph. And the moment you begin investing into the policy, you immediately have what's called a small benefit floor. That's the orange line shown here. Even though your investments haven't grown, for example, day one, you put $1 into the policy, your investments are only worth day one, but you still have that floor. So if you were, for example, hit by a car the very first day of the policy, rest assured you would actually have some protection. Secondly, you're going to have a market value of your investments within the policy, as shown by the green line. And your benefit is going to be based off of, in this example, 4 times that market value. So as you can see here, the moment this green line gets higher than the minimum guaranteed orange line, your benefit would start growing. But what would happen when a market correction occurs? And as we all knew, or as we all know, they do occur. Well, that is when you have a new floor, which is called your step-up guarantee, showed by the gray line. As you can see, your step-up guarantee is going to be a percentage of your market value, a smaller percentage that is, and it steps up each year based off of your policy anniversary date. So in year 11, for example, when you see the market correction and the market value of your account drop significantly, your long-term care benefit doesn't change all that much because you have that stepped up benefit. And then when the market begins to rise and your market value grows higher than what it was at its previous peak, well, then your step-up guarantee begins to grow again. So as a summary here, this type of policy is really designed for those that want that insurance protection, but are comfortable taking on a little more risk to achieve greater returns, which will ultimately allow them potentially to have a higher benefit when care is needed. So this now leaves us, or moves on to the last insurance topic, which are the premiums. How would you cover the cost and how can you pay for those premiums if you decide to utilize insurance? Now, I cannot answer those questions for you all in general because everyone is going to have an individual situation. Everyone is unique. But I can say that the cost of insurance or the premiums you'll have to pay will be based off of your age, gender, health, and the type of insurance policies that you're looking into. The premiums can be funded in multiple ways. However, if you have old insurance policies with cash value or potentially annuities, many times people use those to fund their long-term care premiums through what's called a 1035 exchange. Now keep in mind though that any surrenders, borrowing from policies, or distributions from another policy's cash value is going to affect the original policy benefits and also may create a taxable event. So just ensure you've spoken to a professional before executing one of these somewhat complex 1035 exchanges. Now, if you have retirement dollars, they could be used as well to fund your premiums. But most times what people do, at least what I see, is people set up payment plans for a certain amount of years and they cover those costs with income and with earnings. Like I mentioned, these policies are usually customizable. So to understand what is the best option for you, it's typically best to review your entire financial situation, see what options you have, and then see what is the most cost effective. But enough about the insurance side of things. Let's finish the conversation by talking about what are your next steps if you decide to develop a long-term care plan for yourself. And the first thing is do not make a quick decision on what would be best for covering long-term care. Whether you think life insurance or you think, insurance is right for you, or self-insurance or something else, you should first take a step back and understand exactly what risk exposures you face, and then fully understand the costs and the benefits of the options available to you. Once you do this, you'll be able to really determine a strategy that fits in with your financial plan and your means, and then you can execute on it. Now, this may be, or I guess this may sound weird coming from someone that works with long-term care insurance, but insurance is not always right for everyone. So the last thing that I want you to go out and do is to go out and buy a bunch of insurance policies, something that may not be right for you, may not be sustainable for your family, or just may be too expensive compared to alternative options. I'm a financial planner. I'm not an insurance agent. So when it comes to talking with my clients regarding long-term care, we work on a broad, holistic picture. And really, what it comes down to is analyzing your financial plan, seeing what makes sense, running different hypotheticals, see what risks you're exposed to, and then determining what fits within your plan. So, with all that being said, if you're interested in developing a plan to cover long-term care, please don't hesitate to reach out. If you're a client on the line, just know our door is always open. You can reach out to us, schedule a meeting, and we can talk through whatever is top of mind. We can rerun your planning or review some of the options available for you. And for those that aren't clients, reach out if you have questions. Our door is open, whether you're a client or not. We're always here to springboard questions and ideas off of. And if you want to talk about what a relationship with us and our team would look like, don't hesitate to contact me directly or reach out to us on our website. Well, with that, what I'm going to do now is open it up to questions. And for those that are watching the pre-recorded webinar, I do need to close out now before we get to the Q&A. So thanks for joining, and hold tight, everyone that's on the line. We'll get to the Q&A in just a second.